Good morning and welcome to the FY20 second quarter earnings call for Richardson Electronics. I'll now turn the call over to your host, Mr. Ed Richardson, CEO.
Good morning and welcome to Richardson Electronics conference call for the second quarter of fiscal year 2020. Joining me today are Robert Ben, Chief Financial Officer, Wendy Diddell, Chief Operating Officer and General Manager for Richardson Healthcare, Greg Peliquin, General Manager of our Power and Microwave Technologies Group, and Jens Rupert, General Manager of Canvys. As a reminder, this call is being recorded and will be available for audio playback. I'd also like to remind you that we'll be making forward-looking statements, and they're based on current expectations and involve risks and uncertainties. Therefore, our actual results could be materially different. Please refer to our press release and SEC filings for an explanation of our risk factors. Sales in the second quarter were lower than we anticipated, due primarily to unfavorable economic conditions. This had an impact on our Power Grid 2 business and on refurbished CT system sales. While the semiconductor market started to show signs of life in the quarter, we've had to work with our vendors to pull in critical components required to build parts and assemblies. On a comparative basis, sales to customers in the semiconductor wafer fab market were still good in the second quarter of last year. We expect to see an increase in this business later in the fiscal year. I'm also pleased that our investments in CT tube manufacturing, PMG, and Canvys continue to drive revenue growth. All three areas exceeded prior year sales. In addition to driving sales, our teams are staying focused on gross margin improvement and expense control. We continually look for ways to improve efficiency, such as reallocating headcount and sharing resources across SBUs. In the second quarter, gross margin improved and expenses decreased compared to last year. As a result, operating income was comparable to Q2 and FY19. I'll now turn the call over to Bob Ben, who will provide a detailed recap of our second quarter financials. Then Greg, Wendy, and Jens will discuss individual business unit performance.
Thank you, Ed, and good morning. I will review our financial results for our second quarter and first 6 months of fiscal year 2020, followed by a review of our cash position. Net sales for Canvys increased for the second quarter of fiscal year 2020 by $1.4 million, or 20.9%. Total company net sales for the second quarter of fiscal year 2020 were $39.6 million, compared to prior year's second quarter of $41.3 million, which was a decrease of $1.7 million, or 4.1%. Although PMT net sales benefited from much higher sales of power conversion and RF and microwave components, overall sales for PMT decreased $2.7 million, or 8.4%. Richardson Healthcare net sales decreased $0.3 million, or 12.6%, as a result of lower sales of equipment in Latin America, partially offset by higher sales of our Alta 750 CT tube, which grew by 11.9% in the quarter. Gross margin for the quarter improved to 32.0% of net sales, compared to 31.4% of net sales in last year's second quarter. This was primarily due to the favorable product mix in Richardson Healthcare and improved manufacturing performance in both PMT and Richardson Healthcare. Canvys gross margin was slightly higher than last year's second quarter. Operating expenses decreased to $13.2 million for the second quarter of fiscal 2020, compared to $13.4 million in the second quarter of fiscal 2019. The decrease in operating expenses resulted from lower severance and legal expenses, partially offset by higher research and development expenses for Richardson Healthcare. As a result of the improved gross margin and lower operating expenses, the company reported the same operating loss as in the second quarter of last year, which was $0.5 million. Other expense for the second quarter of fiscal 2020, including interest income and foreign exchange, was $0.1 million, compared to other income of $0.3 million in the second quarter of fiscal 2019. The income tax provision of $0.1 million for the quarter reflected a provision for foreign income taxes, which was lower than in the prior year's second quarter, and no U.S. tax benefit due to the valuation allowance recorded against the net operating loss. Although there is no tax benefit shown on our financial statements from U.S. net operating losses, we can use our net operating losses to offset any cash tax liability reported in our U.S. federal income tax return. The amount of federal NOLs is currently $15.3 million. Overall, we had a net loss of $0.6 million for the second quarter of fiscal 2020, as compared to a net loss of $0.3 million in the second quarter of fiscal 2019. Turning to a review of the results for the first 6 months of fiscal year 2020. Net sales for the first 6 months of fiscal year 2020 were $80.3 million, a decrease of 6.1% from the first 6 months of fiscal year 2019 net sales of $85.5 million. Net sales decreased by $6.9 million for PMT, but increased by $1.5 million, or 10.7% for Canvas, and $0.3 million, or 6%, for Richardson Healthcare. Gross margin increased to 31.9% from 31.5%, primarily reflecting favorable product mix and improved manufacturing performance for healthcare. Operating expenses were $26.0 million for the first 6 months of the fiscal year, which represented a decrease of $0.5 million from the first 6 months of the last fiscal year. The decrease was due to lower severance, legal, and IT expenses. Operating loss for the first 6 months of fiscal year 2020 was $0.4 million, as compared to operating income of $0.4 million for the first 6 months of fiscal year 2019. Other income for the first 6 months of fiscal 2020, including interest income and foreign exchange, was $0.2 million, the same as for the first 6 months of fiscal 2019. The income tax provision of $0.3 million primarily reflected a provision for foreign income taxes, which was lower than in the prior year's first 6 months, and no U.S. tax benefit due to the valuation allowance recorded against the net operating loss. Overall, we had a net loss of $0.5 million for the first 6 months of fiscal year 2020, compared to net income of $0.1 million in the first 6 months of fiscal year 2019. We continue to closely manage our cash position. Cash and investments at the end of the second quarter of fiscal 2020 were $46.1 million, compared to $46.5 million at the end of the first quarter of fiscal 2020 and $53.2 million at the end of the second quarter of fiscal 2019. During the quarter, we repatriated a total of $4.4 million from Germany and the Netherlands. U.S. cash was $24.3 million at the end of the second quarter of fiscal 2020. Capital expenditures were $0.5 million in the second quarter of fiscal 2020, compared to $1.1 million in the second quarter of fiscal year 2019. Approximately $0.2 million related to investments in our healthcare growth strategy, $0.2 million to our IT system, and another $0.1 million was for facilities and other projects. On a year-to-date basis, capital expenditures totaled $0.8 million, as compared to $2.2 million in the first 6 months of fiscal 2019. Free cash flow for the second quarter of fiscal 2020 was $0.144 million, which was an improvement from the second quarter of fiscal 2019. Lastly, we paid $0.8 million in dividends in the second quarter of fiscal 2020. Now, I will turn the call over to Greg, who will discuss the results for our Power and Microwave Technologies group.
Thank you, Bob, and good morning, everyone. PMT sales in the second quarter of fiscal year 2020 were $29.6 million versus $32.3 million in Q2 of FY19. Our gross margin improved in the quarter to 31.6% versus 31.3% in the prior year. Q2 results, when compared to prior year, were once again impacted by the year-over-year sales decline with our major semiconductor wafer fabrication customers and a slowdown in the power grid tube business. However, this decline was partially offset by continued strong growth with our new technology partners supporting the RF and power markets. Another positive trend was our book-to-bill. The book-to-bill was 1.12, driven by strong bookings from our wafer fab customers, key tube product lines, and our PMG business unit. Our bookings growth for our EDG business unit was based on continued engineering and logistics support of the wafer fab market and global infrastructure to support our OEM and MRO customers. The growth in PMG bookings is due to our new technology partners' products, our demand creation model, our numerous design wins, and our unique global business model. We have improved our go-to-market strategy by investing in key development resources to greatly improve our customer contact in a more efficient manner. As the market conditions dictate, we continue to take control of our SG&A and invest in key growth areas, as I just mentioned. We also continue to implement strategies to improve our efficiencies and increase our customer contact. These actions allow us to generate more opportunities in growing markets using our existing global infrastructure and headcount. This will have a positive impact on our performance for the balance of the year and into the future. Our revenue growth with our new technologies is being supported by key partners such as Qorvo, MACOM, Nokia Wave, United Silicon Carbide, and Fuji Semiconductor. Our core legacy business continues to be greatly supported by the key tube manufacturers in the industry such as CPI, Thales, NGRC, and Photonis. Key markets and applications showing growth in the calendar year 2020 include 5G wireless infrastructure, SATCOM, and power management. Specific to 5G infrastructure markets, we are continuing to gain traction throughout the world. With our experienced field sales engineers, we have seen hundreds of ongoing opportunities and are consistently growing our list of design wins in the base station, mobile test equipment, SATCOM, wind energy, and motor control applications. Our global sales team is of great value to our customers and suppliers in these power and wireless infrastructure rollouts. I want to reiterate the importance of our bookings. We are very excited about the booking trends in both business units. In our Power and Microwave Group, or PMG, for RF and microwave, our growth in calendar year 2020 will be in the SATCOM and numerous 5G applications, such as infrastructure, test equipment, and telematics. 5G will be supported by these key suppliers, including a Nokia Wave, MACOM, Qorvo, and numerous current and new RF passive technology lines. We also have a large and growing backlog in the Power Management Group with applications including motor controls, UPS systems, and wind energy products ranging from active components for United Silicon Carbide, Fuji Semiconductor, to ultracapacitors. And finally, passive components from LS-Mtron and Amotech make up the balance. It is also great to see strong bookings in the quarter from our key semi-wafer fab customers, along with incremental bookings growth in our tube business. I can't stress enough the value of Richardson Electronics' unparalleled capability and global go-to-market strategy that is unique to the power and microwave industries. Our world-leading position in the manufacturing and distribution of electron devices supports legacy equipment, as well as new equipment where solid state cannot replace tubes. The combination of these two niche strategies separates us from the competition and has been proven successful. With that, I'll turn it over to Wendy in Richardson Healthcare.
Thank you, Greg, and good morning, everyone. Overall healthcare sales were below prior year due to a significant decline in equipment sales. Our refurbished CT systems are sold primarily to customers throughout Latin and South America. Given the economic and political turmoil in countries like Bolivia and Argentina, we've suspended open credit terms to many of our customers in these regions. Parts revenue was also down slightly in the quarter. The number of transactions were up, but the average selling price was lower. On a year-to-date basis, part sales are still well above prior year. Revenues generated from tube sales were up over second quarter last year. Sales of our Alta 750 tube increased, while we saw a decline in certified pre-owned tube sales. Our longest life tubes are now nearing the 600-day mark. With a good inventory of the Alta 750, and as customers continue to gain confidence in the tube, we are harvesting fewer CT systems. This leaves us with fewer pre-owned tubes to sell. Our field sales organization is creating awareness for the Alta 750, stressing the alternatives hospitals have to the OEM. This process takes time as many systems are under multi-year contracts, and customers are reluctant to change unless we have a full service option. We have a strong network of third-party service partners, and we are working with others to fill any gaps. Our training programs are critical in this regard. Having our flexible P3 programs that mitigate risk, like an insurance policy, is also an advantage. Hospitals and third-party service organizations normally won't stock tubes or parts, but instead they order them when a system fails. So for us, staying in front of customers is critical. While tube sales are still lower than we originally anticipated, they are steadily increasing. Now that we have the CE mark, we are seeing more interest for the Alta tube in the European countries, as well as countries surrounding the European Union. Our efforts to obtain regulatory approval is ongoing in other countries where demand for an alternative to the OEM is strong. We are currently working on China, Korea, and Russia. Canon continues to fight for its market share, creating price pressure. This is more prevalent in the European countries. Gross margin in Q2 improved to 34.3% versus 29.4% in last year's second quarter. Year-to-date gross margin is now 34.1% versus 24.3% last year. Our manufacturing yield is improving, and we are putting more tubes and heat exchangers to stock. We still have room for improvement as we strengthen our processes and we increase production. The improvement in gross margin is also related to product mix. System sales in Latin America tend to have a lower margin. We did sell several systems in the quarter that offset some of the margin improvement, but generated cash and cleared out some old inventory. Our tube development activities continue to run according to plan. We anticipate having the Alta 750G version in customer beta sites this summer. Provided everything continues in this manner, full production will begin by the end of calendar year 2020. In the interim, it's all about sales and staying in front of our customer base. I'll now turn the call over to Jens Ruppert to discuss second quarter results for Canvys.
Thanks, Wendy, and good morning, everyone. Canvys, which includes the engineering, manufacture, and sale of custom displays to original equipment manufacturers in industrial and medical markets, delivered strong performance with sales of $7.9 million during the second quarter of fiscal 2020, an increase of 20.9% over the same period last year. The revenue increase for the quarter was related to increased customer demand in both North American and European markets. Gross margin increased slightly as a percentage of sales in the second quarter of fiscal 2020 to 32.9% from 32.8% the same period last year. The increased gross margin was related to a favorable product mix. Q2 fiscal 2020 was another strong quarter for Canvys, with book-to-bill of 1.97. We were able to increase our backlog to an all-time high in recent history. Our backlog consists of purchase orders that typically ship over 1 or more years. Customers issue call-off orders that vary quarter to quarter based on customer demand, component availability, and other factors. The healthy backlog position, along with a number of projects that are currently in the engineering stage, position us well for continued growth. During the quarter, we received several new orders from both existing and first-time medical OEM customers. Applications where our displays are used are numerous. Some of these include real-time cell analyzers to determine the metabolic phenotype, cryolipolysis systems that break down fat cells by cooling of body fat, corneal cross-linking, a minimally invasive procedure that combines the use of UVA light and a special eye drop to add stiffness to corneas which have been weakened by disease. Refractive surgery, a femtosecond laser system for therapeutic and refractive applications of cutting-edge corneal surgery. Patient monitoring, where our monitors are installed at the patient's bed or a remote location, such as the central nurse station. DICOM-compliant monochrome displays for C-arms. Surgical navigation, a system that enables surgeons to precisely track the location of surgical instruments throughout a procedure. Laser systems for treatment of peripheral and coronary arterial disease with photoablation, and a very new project that finally entered mass production stage in the robotic-assisted surgery space. Navigation data will be used to control a medical device. In the non-medical space, we received orders for various displays and all-in-one products. Applications include passenger information systems used on trains and buses, where special certifications are required. Product dispensers used in retail stores, displays used in control rooms in the public transportation market, and touchscreens used as human-machine interface for large-sized billboard printers. We continue to look for new customers through trade shows, online marketing, referrals, and cold calling. Considering all the new programs we are working on with existing as well as new customers, I'm very optimistic that we will continue growing our business. We have proven ourselves to be a highly reliable, versatile technology company with the ability to meet a diverse number of displays requirements, as well as being in compliance with the upcoming MDR. I will regularly review and adjust our business strategy with the goal of further improving the operating performance of the division. Maximizing cash flow is an ongoing priority, and we continue to focus on inventory turns and collections. We will work closely with our partners that help us reduce inventory by being able to meet the demand of our customers. I will now turn the call back over to Ed.
Thanks, Jens. Congratulations on having a record quarter. We see good momentum across all three of our business units going into the second half of FY20. PMT should benefit from continued growth within PMG and also with the semiconductor market improvement. We anticipate healthcare sales will improve as our tube life increases and customers gain awareness and comfort with the Alta 750 throughout the U.S. and Europe. Canvas is already performing well, and the team continues to win new projects. We'll closely monitor sales performance and make changes as necessary. We'll also stay focused on cash management. At this point, we'll be happy to answer a few questions.
Thank you. If you wish to ask a telephone question, simply key star then 1 on your telephone keypad. If you decide to withdraw your question or it has been answered, it's star 2. So to ask a question, it's star then 1. Please stand by for your first question. Your first question comes from the line of Eric Landry, BML Capital. Please go ahead. You're live in the call.
Good morning. Good morning. So, Greg, in EDG, was there any push-outs or anything like that?
No. Our bookings were very, very strong in both. The slowdown in terms of sales, like I said in the past, with the PMG growth, we were able to offset the decline in the semiconductor wafer fab business. However, we weren't expecting the slowdown in the tube business. But that slowdown was across the board. We didn't lose any market share. We didn't lose any big customers. And there weren't any big push-outs from our customers that caused that. It's just a slowdown in that type of MRO business across the board.
So does that mean in the quarters going forward here, we're going to have to deal with a declining EEG business?
No. If you look at the book-to-bill with EDG was strong in the quarter, and compared to Q2 of last year, their bookings are up 17%. So going forward, Q3 and Q4 should show growth year over year for both EDG and, of course, PMG showing excellent growth.
Okay. So how long do you think it'll be before the growth in the PMG can overtake any volatility in the EDG business?
I think that'll happen this year. If not this fiscal year, definitely 2020 calendar year. It's already offset any sort of declines within these large markets for EDG, like the semiconductor wafer fab market. The slowdowns in the tube business are, usually single digits.
And if I look at the backlog, for example, the backlog's up close to 30% in PMG. So you're quarter over quarter. 2020 calendar year, we should show growth quarter over quarter, in year over year.
Okay, thanks.
Yep.
Wendy, what's been the field performance of the Alta tube so far?
Hi, Eric. It's been fairly good. We're actually pleased with the results.
So there's been sort of no issues with it performing not up to standards. It's performing fine, in other words.
It's performing up to standards. We have had a handful of returns. We understand what the issues are when we get them back. We've put improvements in our manufacturing and development process in place. But in general, I think that the field expectations and our customers' expectations are being met. The tubes are, as we pointed out, are nearing 600 days, the longest life tubes. And I can't point to any single customer who's saying, we're not going to buy your tubes because we don't trust the quality.
So then, so can we blame the slow start, the whole slow start, on the fact that there is no G available? Is that the sole reason that this thing is off to such a slow start?
No, it's a part of it. It is definitely a part of the reason. Again, a lot of the systems, and I think we've said repeatedly that at least 80% of the systems in the U.S. and possibly even higher as we get into Europe are under OEM contracts. And those OEM contracts are usually multi-year. So part of the slowdown is waiting for those systems to come off of contract. Part of it, as we've pointed out, is definitely waiting on our ability to prove that we've got long life, which I think every day that goes by we're getting there. So it's a combination of those factors, Eric.
All right. So you said in the last call that you got the CE mark at the end of the last quarter, and that the initial response was "quote unquote" very, very positive. Are you having the same conversion issues in Europe that you've had here for the past 4 quarters?
It's slow as people, again, wait for equipment to come off the contract, so that's still an issue. I would still say that the reception has been good. I don't see any change in that expectation. So I can't really add anything more to that, Eric. I think that, Europe is getting started, and we have a couple large customers that have committed to using our tubes, and it's just now a matter of time for equipment to fail and for them to need our tubes.
Okay. All right, thank you, Winnie. Ed, I've got sort of a bigger picture question here for you. Obviously, the quarter was disappointing, and I know that you've said many times that you believe healthcare is the future of the company. But to us on the outside, it's hard to have confidence that this future is going to, that the future is much more positive than the past after quarter, like we're having. So I'd like to know if there's been any type of meaningful discussion within the company or on the board on any type of a strategic action that you could take to show your shareholder partners that there is eventually going to be some hope of creating value here.
I think that, the board members, most of them have been CEOs of tube companies in their own right. And as you know, for example, Bob Kruge's on our board, who was CEO of Varex, or at that time it was Varian's imaging business since 93, somewhere in that time frame when he came there from GE. And I really feel that, they think we're right on the edge of starting to show some good results, and actually anticipate that our investment is probably going to be larger than we thought it would be to begin with. But overall, the results are good. We're seeing competition, as Wendy mentioned, from from Canon, which is, I think, to be expected. They certainly don't want to give up a huge aftermarket at very high margins if they don't have to. But overall, I think we're right on line for where we anticipated to be.
So when you say that they think that you're right on the edge, I mean, is there anything that you could tell us that gives us confidence on the outside? Because we obviously don't see what they're seeing, but it's hard to have confidence that you're on the edge when we keep seeing this sort of flailing quarter after quarter.
Oh, I think they're seeing the yield on the tubes, and the yield continues to improve. And as that happens, we have a cost that's set based upon the current yield. As the yield in manufacturing improves, that cost will go down and will be even more competitive. So I'm pretty sure that's what they're looking at. And they understand it because they've all been CEOs of two manufacturing companies in their own right.
Mm-hmm. Okay, thanks.
Mm-hmm.
Thank you. A very quick reminder, if you wish to ask an audio question, simply key star then 1 on your telephone keypad. Your next question comes from the line of Mark Silk Investment Advisors. Please go ahead. You're live in the call.
Thanks for taking my questions. So, Wendy, on the CT replacement tubes, I guess one of the issues back in the day was the first one you implemented was you need time to see if they work. So the first tube that you implemented, was that been 2 years now?
It's almost 600 days.
Okay, 600 days.
587, I say.
So how can you now? So now that's not really an excuse anymore. So I'm just trying to get because it sounds like this is really a great growth area. So I just want to get my arms around like your selling strategy. Are there boots on the ground? Are there phone sales? Do you think if you were the CEO, would you be adding more boots on the ground to get in front of these customers? Because if it could be an explosive area, I would think that that's probably where the company should, maybe put some more resources. I would just hope for you give me some color. That would be great.
Sure, Mark. That's a good question and a fair point. We have a very strong outside sales effort as well as an inside sales team. We've actually taken the inside sales team and we've beefed that up and added people whose sole purpose in life is to make outbound calls to the hospitals, to the third-party service engineers, to really identify where all the Toshiba equipment is. And it's really now about staying in front of those customers and reminding them on a very regular basis that we've got the tubes in stock. So when they have a failure, whether it's a tube failure or a part failure, they know immediately or they think immediately Richardson Healthcare. But we've got a good, solid team. We've got significant numbers. Do I personally think if we keep throwing more people at it, it's going to change the dynamics? Not a lot because of the other issues we've discussed. We have to wait for the systems to come off of OEM contract. We have to wait until we've got a broader line with the G-tube that will help convince more of those customers to take their systems off of contract. And it's really just having that the stick-with-it power. We've got to just keep calling and getting in front of those customers. From a high-level perspective, Ed, myself, Gerald Olson, we have Derek in the Carolinas. We have Dean in the Carolinas. We've got a full team of people that can go out and sit in front of C-level people, high-level people within the hospital organizations, certainly with the third-party service organizations that can tell the story and give them all the good reasons why it makes sense to change from the OEM.
I know your headwinds are probably not many people know your name, but what would be some of the tailwinds for you guys? And maybe there's other headwinds that maybe we aren't thinking of in this area.
Okay, just in healthcare?
Just on the CT. On the CT.
Yeah, staying with that.
But if you want to add more to that, that's fine.
Well, I'll start with healthcare. If the other guys want to add some, they can. But I think we've kind of covered what the headwinds and, let's start with the headwinds. We know what those are. We've talked about, again, the timeliness of getting systems off of OEM contracts. We've talked about longevity of tubes. And so, again, we've got some history behind us now, and I think we'll start to see more and more of those systems being converted to go off of the OEM contracts. So I think that's good. That becomes, at some point, it becomes kind of the tailwind you're talking about and pushing us forward. So I don't want to continue to to basically be repetitive, but what we've talked about so far are our headwinds. And again, we've overcome and started really getting the name out there. I don't think Richardson Healthcare, by the way, is now kind of an unknown. I mean, we've been out there now for almost 5 years, if you include IMES, and I think people know who we are. And one of the tremendous advantages we have is when we get those customers here, by the way, Mark, and they can see our facility and they understand the investment that we put behind this healthcare organization and behind the tube manufacturing facility, they become even more confident and more impressed. So again, for me, it's truly, truly about staying in front of those customers, getting them here, letting them see and touch and feel and talk to other people who are using the tube to understand that we're for real and that it's a quality product and it's a viable solution to the OEM.
Okay, that's good color. So Ed, last conference call, as you had another losing quarter, I kind of brought up to the fact that, I think your salary is extremely high for a company that's losing money. And you said, well, I didn't make money back in the day, so now it's like catch up. But you're also getting dividends. So, you talked about this board of CEOs, and I would think that if I was on the board, the first thing I would say is, listen, why don't you bring your salary down until you can show consistent earnings instead of losses, and then we can adjust your salary, because I don't think these people are going to tell you the emperor has no clothes, and I don't know if, because of the dual stock, you're going to vote these guys down and you can throw them off the board. So I think the right thing to do is reduce your salary, which helps the bottom line, and then when you get to be profitable and consistently profitable and the stock moves up, you should deserve that salary. So that's kind of my comment. If you want to comment on that, that's fine, but we're all in this together, right? So if the stock goes up, we'll all make money, but I just think maybe the buck stops at the top to maybe set an example.
Well, we certainly appreciate your opinion. It's been stated before, and, the board takes all that into consideration, and we move forward accordingly.
Thanks for taking my questions. Good luck.
Thank you. Your next question comes from the line of Brad Leonard, BML Capital Management. Please go ahead. You're live in the call.
Hello, and thanks for taking my question.
Hi, Brad.
Hello. You guys, I guess overall you've done, if we look back at this, a pretty good job of controlling costs, and you're operating at plus or minus break even most quarters, which is fine. But if we step back at this, I think if you're going to be honest with what the company is doing, you just have to realize that you're just not making any progress. And the healthcare is, in my opinion, it's been a bust. You guys you've done $4.9 million in healthcare sales this year. I don't know how many CT tubes you're selling, but it can't be very many. So while it may hold promise, you might think it is, you're just not making any progress. It's been much more difficult than you thought. And it just doesn't seem like there's any incentive to really take any strategic actions to create shareholder value. And this goes to, I just don't, Ed, did you ever think about selling this company, selling off divisions and saying, hey, this is not working what we're doing. We've been doing it for a long time, and we're just not making a lot of progress. Maybe we should be selling this business to a larger company who can take out costs, eliminate duplicative public company costs, management salaries, et cetera. Does that even cross your mind or the board's mind?
No, it really has not. We're absolutely committed to the healthcare business, and we think we've made good progress in that area. I understand you do not, but everyone is, welcome to their opinion. The board thinks we're making excellent progress, and as we're able to bring the yield improvement up, the costs will come down, makes us even more competitive in the marketplace. We're absolutely committed to healthcare going forward.
Well, if you look at the healthcare sales, and if the board thinks you're making progress, your sales were $2.2 million versus $2.5 million quarter over quarter. That's not progress. So you can say this, the board, we've got ex-CEOs, all this. I mean, the board really has no say in this. You've got voting control. The board is just there as placeholders in a public company. They are, and I agree with the past callers, we should adjust the salary. I mean, if you're really in this and you really want to drive shareholder value, your salary should be much less and your incentive comp should be much higher. I would pay you 3 times as much if it was 20% salary and 80% incentive comp based on profitability and progress. And we're just not making it. I think you're all working hard. I think you're competent people. I think you're probably honest people, but you're not making any progress. Shareholders are not being rewarded. I mean, it's a stagnant company that is just existing, and it trades below net current assets for a reason, because you guys are just unwilling to take the steps necessary to drive value. And it's not lack that you're trying. It's just not working. I mean, at some point you just have to step back and say, hey, what we're doing is not really working. We're not making any money as a company. We're not driving an increased stock price, which is baffling to me that you own 2 million shares and you don't want to take any actions to drive the stock price higher. It's just status quo of existing what we're doing. And so I don't know. I think it would really benefit shareholders if you, because the board doesn't really have any say, if you would think about selling this business, selling off a division.
Well, I've heard your opinion before, and, it's been shared with the board, and fortunately, we don't think like that. We're absolutely committed to the healthcare business, and we think...
Fortunately, you don't think like that. Fortunately, Ed, the stock price hasn't moved forever. I mean, unfortunately for shareholders, you don't think like that. I mean, it's just like, I don't even need to hear anymore. I think we've heard enough, and shareholders have probably heard enough. But thanks for your time, and best of luck.
Thank you.
Thank you. Your next question comes from the line of Kevin Rendino, 180 Degree Capital. Please go ahead. You're live in the call.
Yeah, Ed, hi. It's Kevin Rendino. I thank the rest of your team for their comments on the business. They sound like very smart people that know what they're doing, and I certainly appreciate the dialogue around that. I have to just chime in here that somebody said earlier the quarter was disappointing. It's not the quarter that was disappointing. It's literally the entire tenure of your ownership of this business has been disappointing. And another caller sort of asked or said, we're all in this together. We're not in this together. You own 2 million shares. You take out $500,000 a year just in dividends. You don't own stock, so you don't care about the stock. The board doesn't own stock, so they don't care about the stock. You've literally committed a fraud against your shareholders for a very long period of time. And I think you should just be honest about all of this. And instead of continuing to perpetuate this fraud over your shareholders and pretending that you care what they care about, you should just take the company private and do what you want, as you have been doing for the last 20 years. Don't hide behind the board. The board has no say. The board has no gumption. They're not doing anything that they should be doing, which is looking at strategic alternatives. And if you're going to be honest about all of this, you should just take the company private and do what you want to do, and nobody could have any voice in saying or giving you any opinions of what you should be doing, because quite frankly, Ed, you don't care. And just admit that you don't care. Just say it so we can all move on. Thanks.
Well, again, we certainly appreciate your opinion, and, we choose to disagree with it and think that what we're doing in healthcare is going to be our future, and that's where we're making our investments.
That's great, Ed. You've been a failure. The business has been a failure for 20 years. You've created no value for 2 decades. You should listen to other people other than yourself and the board. You should welcome an investment banker to come in there and give you some advice, because the advice that you're giving yourself isn't working. Thanks.
Thank you. We have no further questions.
Okay, Mark. Thank you very much. We appreciate it. If anyone has further questions, give us a call after the call. Thanks.
Thank you. That concludes your conference call for today. You may now disconnect. Thank you for joining and enjoy the rest of the day.